This morning we heard about cities and we looked 20, 50 years into the future, but what's going to happen in the next 12 months? So all of you, you've returned from international roadshows over the last month or two. What are international investors saying? Are they still keen on Australia? What do you think, Darren?
Yeah, it's always pleasing to get on the road and get out of the sort of myopic Australian economy and the myopic Australian investors, because when you go on the road, you can see the world, and the capital today is globally is spread globally. So what happens is you go to up in Asia, and they say when you look at the GDP growth, when you look at the population growth, when you look at the transparency, when you look at the yield coming off the assets, they look at our market and go, you are so lucky to have a business there and to be working there. And you compare that to, and what a lot of these global investors do, is they compare that to Europe right now, which is in youth unemployment 30-40% in some countries, growth relatively flat, negative in many of the countries. You compare it to the UK, where you've got Brexit going on. They compare it to China, which is very lumpy, but if you believe the numbers, it will always grow somewhere between 6 and 7%, no matter what it's actually doing, because no one really knows. And they come back, they look at the US, which looks like it's improving, and when they take that global snapshot into account, they're gravitating down to Australia, and it's very pleasing. And you do have very global discussions rather than what's happening in the fourth floor of Governor Phillip Tower.
Okay. And Darren, can I remind you, it's the fast five, so fast answers.
Yeah, I was going to say they view it positively.
That was one quick response from Peter. What about you, Susan?
Positive.
Okay, now I'm making my job really hard for myself. Okay, so we've seen this rush of capital, but has international cap topped out here? Have we had the rush and it's going away now? David?
Look, I think you've got to split capital between listed and unlisted. The listed capital that comes into Australia typically doesn't hedge its currency, so they get very nervous when there's a perception that the Aussie dollar might be under pressure, and obviously with the US, every day wondering when the Fed's going to lift and how much. Obviously there's a perception of rising interest rates in the US, and therefore there's a little more nervousness from listed capital. On the unlisted side, as Darren said, this is probably the most eclectic demand I've seen from wholesale capital from every jurisdiction in the world looking to buy yield in Australia. So I think the physical market is in good shape, the demand is going to continue, and you're going to see, as we have seen for decades, sometimes a disconnect with the listed world versus the physical world, but over the long term, they generally correlate.
Okay. Well, we've had that rush of investors chasing yield, and they've paid some big prices. So are we going to see offshore investors burned for having paid too much? Will it be a rerun of the Japanese collapse of investment in the 1990s? Peter?
I don't think so. I think Australia is really well positioned. I think even this morning when we're talking about population growth, 1 million people every 3 years to Australia really just underlines the overall GDP growth of the country, and I think investors are going to get burned.
Okay. And Kylie, what do you think?
Yeah, no, I would add to that. I think capital is actually remaining very disciplined. So they have low leverage. Their underwriting is extremely disciplined. They are looking at long-term positions. They are factoring in conservatism in their terminal values, and I think they're still buying wisely.
Are you worried about the Chinese in terms of how much they're paying and their own economy?
For commercial real estate?
Yeah, for commercial.
Well, no. I mean, I think we're getting a really broad mix of capital coming from all around the globe at the moment. It's actually not just China driven at all. There's a lot of capital coming out of the US market, which we haven't seen a long time in Australia. We're getting capital from the European markets, Singapore. It's quite broadly spread at the moment.
Okay.
And Terry, it's easy for you to sit there in the press all saying, look at these record prices they're getting. But the key point is a lot of this capital has lower return hurdles. So for them, it's actually quite cheap and well ahead of their return hurdles. So you only look at one spot, just looking at the price.
Yeah, and on a relative basis, very attractive on a global scale.
Okay, well, yields have gone down. I see there's some questions coming up from the floor, but I'm just going to sneak this one in. I'd like you all to make a forecast. How low can yields go? What's your forecast? How much more contraction or no contraction, Peter?
I think there's definitely going to be further contraction. I think that, as Darren mentioned, you know, the return expectations from investors is going to mean that with lower growth from a global point of view, that those total return expectations are going to reduce, and therefore yields have to reduce as well.
Susan, can you put a figure on it?
A year ago I was wrong, because I said this a year ago, that I think we're towards the end of the cap rate compression. There's maybe a little bit more, but the next part of the cycle is going to be all about income, and happily the fundamentals are going in the right direction to make income take over from cap rate compression in terms of creating total return. But cap rates, no matter how low interest rates are, cap rates in Australia do not go below 5 very often for very long.
Okay, Darren?
25 to 50 bips, but it's very asset specific and state specific. So you're not going to get cap rate compression in Perth anytime soon.
Yes, that's a bit of a broad answer, a bit of an outlet there. And David?
Look, I think the stats are pretty obvious. The spread of IRR to bond yields and the spread of income yield to all-up cost of debt is still way above the through-the-cycle average. So I think there will be some compression. As Darren said, I think it'll be bifurcated. I think quality assets with relatively low risk are going to continue to be bid up, and the risky assets, and we're seeing it with selling secondary assets at the moment, yes, it's strong, but it's patchy, and it's very hard for people to get debt if there's, you know, risky shorter lease assets. So I think it'll be quite bifurcated, but more or less I think we're seeing 25 to 50 basis point compression in quality assets ahead of us.
Kylie, are you putting in a different
Particularly
figure?
anything that has scarcity. But I agree with all the comments, but I would caveat that I think the credit markets are going to play a big part in what happens, and if there is any impact in credit, it is going to flow through to those returns very quickly.
Okay. Should we have a change of pace from the floor? We'll go through everybody on this one. The question is, how do you rate your company's diversity efforts on a scale out of 10? And what about the broader industry? Do you want to start this time?
Happy to. I'd rate our effort a 10 out of 10. We're not there yet. We still have a long way to go, but we're very focused on it and right through our organisation, and it's very much driven right from the global leadership team.
Then how would you rate your performance? If the effort's 10 out of 10, how do you
Oh,
think
look, I think we're doing pretty well. I certainly in our property business, we have 56% of our staff are women. We're getting more and more into senior ranks. When we get too high up, we still need more work, as most organisations do. But we're spending a lot of time creating that opportunity and supporting progression through the organisation.
David? And we'll go down the line.
10 out of 10 effort, 7 out of 10 achievement.
Okay, fast. Darren?
8 out of 10 and 6 to 7 out of 10, but I think it's really important to say that diversity isn't just a gender issue. Diversity is about, you know, Asian, Chinese, gays, you know, whatever, you know, diversity's become all about gender, and true diversity is a true diverse group around the table making decisions.
Do you think other than gender is lagging then?
Yeah, I think the
parts of
focus has all
diversity?
gone to gender, and there's nothing wrong with that because we know we've been lagging, and we're doing a lot of work on that. And many of my colleagues up here are on the Property Mail Champions of Change. However, we just need an open mind about true diversity, and true diversity is not just a whole lot of men and women from the lower North Shore of Sydney, for example.
But
I think
Like,
we've got. I think
I
we've
think
got a
that's us.
snapshot. Oh, look at that! I didn't even realise it.
Does anyone live over the bridge?
So I agree with Darren's point about you've got to get to real diversity, because it's diversity of thought that you need to get to, and for that you need an inclusive culture, because you can have a whole lot of diverse people, but if they won't speak up, it's pointless. So I think our efforts are all, and I'll give us a 10 for effort as well, are all about how do you create true diversity of thought and an inclusive, safe culture.
Peter?
Yeah, definitely. I think a safe culture is really important because everyone's got to be able to bring themselves to work, and their own selves to work.
How do you
And that's
rate your
really important.
performance?
But I would rate ourselves probably 8 out of 10 in terms of what we've accomplished to date. But certainly the effort is there, and as Kylie mentioned, I think that, you know, unfortunately the higher ranks of our organisation, we have less female representation. I think in our top 80 it's about 32%, but we're working really hard to address that. But I think to the other point is it's really important. I think if you can get gender diversity right, then I think it really helps in getting the rest of diversity right. So it's a great starting point.
Okay. Ken Morrison and Kathy McDermott will be writing down those figures and holding them up next year to see how you're going. Okay. Now, I've got some more questions from the floor. This one is, what's the biggest risk for the industry in 2017? David, do you want to jump in?
Oh, look, I think there's no doubt. If I look around this room, a few of you have been through the financial crisis. a few less at the tech wreck, and a few less the last time we had a recession in this country, and then even less at the 81 recession. So in all of the cycles I've been through, most of the trouble comes from a financial credit squeeze. And as Kylie said, I think the biggest risk is really if we have a global credit squeeze. We all know the Australian banking sector is reliant on roughly 35-40% wholesale funding. We have 4 banks really that is funding the sector, and the knock-on effects of that, I don't see it coming, but it is, in my opinion, the biggest risk to the sector.
But to that point, I think if that does happen, and these are the things you rarely foresee, I think most listed companies are in much better position from a leverage point of view. Debt profiles are much better. There's very little short-term debt that if there was a credit crunch, it's not going to be the same as it was in the financial crisis, I don't think. As Kai was saying, the leverage in the unlisted, very low. So yes, a credit crunch or a squeeze would be a problem for the industry, but nowhere near the magnitude of the problem we saw last time around.